Welcome everyone to our YouTube live, and let me just welcome you all to our 1 hour session. And I've actually ordered a burger, so it's going to arrive in 1 hour's time. So that'll draw a natural conclusion to the events. So if Laura dashes off at the end, you'll know why. And Teddy usually barks as well if there's someone at the door, so you'll know. So this week, for the Patreon supporters, we've done a video about whether bonds are in a bubble. And it's kind of interesting. You can look at the level of GDP growth, and that's been a fairly good predictor of where the kind of fair yield is for government bonds, particularly the long-dated government bonds. And I won't give the game away, but bonds aren't correctly priced, but they're not far off where they should be based on what's going on with GDP at the moment in the US. So there isn't a huge bubble, I don't think, in government bonds at the moment, given that growth is fairly lackluster leading into the crisis. So that was the video for supporters. And we also looked at the Fed model, which compares earnings yield on equity with the 10-year Treasury rate to see whether equity is looking cheap relative to bonds or not. So that was the video for this week. And of course, this week we also talked, the video that's about to come out on YouTube is stagflation. So it's all about whether we're kind of going to come out of this pandemic and go into this era of high inflation and low growth, which is really atrocious for investors. It really is terrible. And Teddy's licking my hand, so I suspect he wants a treat. There we go. Yes. He's just had a haircut, so he's looking very smart at the moment. Anyway, so that's the video that's coming out on Saturday. But if you're a Patreon supporter, you'll be able to see that straight away. Teddy licking my tummy is not going to get more treats. It's not going to work. Okay, so let's start thinking about the questions, and we have an hour together. Now, the usual procedure applies, which is that if you're one of our YouTube supporters, and you can become a supporter by clicking on the join button underneath this video, then your question will be pushed to the front of the queue. Or if you have a super chat, also we'll push your question to the front of the queue. Sometimes we have lots of supporters on the call, and so we answer those questions first, and everyone else takes a kind of back seat. Sometimes we don't. We'll just have to see how it goes tonight. So let's get started with some of the questions. Do we have any member questions? No, not yet. Okay. So the first question is from Rob A, who is asking about inflation-linked gilts. There's an ETF called INXG, which has gone up 10% in the last 6 months. What figures should inflation reach for it to keep rising? And what factors could make it go down other than an interest rate hike? Well, I mean, as I said, in this video that I've just done for Patreon supporters, I think a driver of long-term yield is growth. Now, in the case of linkers, clearly, if inflation increases, that's good for those bonds. Whereas normal government bonds, inflation is toxic for them. But in the case of long yields, because UK inflation-linked bonds are very long duration, the long end of the curve is what drives their price. And if interest rates increase due to greater growth expectations in the UK, then that would be bad for your inflation-linked bond ETF. So INXG, I think, is the one which gives you exposure to the UK. Let me just quickly look that up to see whether that's the case. Yes, it looks like it's index-linked gilts. So that will be the UK yield curve that you're getting exposure to. So for you, what's going to be bad is if UK growth surprises on the upside, and then the bonds will be pricing in a higher growth rate, the yields will rise and the price will fall. And because UK gilts inflation-linked gilts have really long duration, about 20 years. Even a slight shift upwards in the yield curve is going to be bad for those bonds. So higher growth for the UK is bad for you, because remember, bonds feed on misery and economic hardship. So if there's news of economic improvement, it's going to be bad for those bonds. I think the other thing to bear in mind is that inflation break-evens in the UK are fairly high. So remember that inflation-linked bonds always have to climb an uphill battle, because when they're issued, they usually have a smaller coupon than an equivalent non-inflation-linked bond. And that means that to catch up, inflation has to reach a certain level before that happens, and that's called the break-even of the government bonds, of the inflation-linked bonds. So if the inflation-linked bond break-even is very high, then it could be that, you know, inflation just doesn't get that high, and you'd have been better off with nominal bonds. Also, with those bonds, the INXG fund. Let me just share my screen so you can see that. With that one, the duration will be very long. So let's have a quick look at it, just so people can learn how to read these for themselves. And I'll be the little thing in the corner here, make it a bit bigger. And I'll make that full screen. So here it is. If we scroll down to the bit about duration, so if I just search for the word duration, the effective duration of these things is huge, 21 years. So if the UK yield curve increases by 1%, this thing will fall by 21%. So it's a big multiplier. Just be aware of that, because it could hurt you. So I assume if you've had this thing for a while, you're aware of its very high volatility. That's just part of living with this investment. Now, personally, I don't believe that we're going to have inflation that's particularly high in the US, but I think in the UK that's not a bad idea, because here I think we could have the potential for a wage price spiral, because we've got a restricted labour pool, we've got supply chain issues, and both of those things could be inflationary. So there's a potential for a kind of wage price spiral, and that would lead to longer lasting inflation. In the US, I don't think there are such high risks of that happening. So I think, you know, in the US, the transitory narrative for inflation is more plausible. In the UK, less so. Okay, so back to me. You're about to say something, Laura?
As a member's question.
Members question, right. So let me just...
Like and share. Oh,
yes. Do like our stream. And it's easy for you. Just do a thumbs up, even if you're watching in replay, and share it with your via social media, because, you know, other people might find it interesting. And hey, you'll get the kudos of sharing it with them. Something so valuable. Right. So let's just go to the question. Oh, I realise you're looking at my screen, not me. Okay. Hello. Right, so back to the question. And okay, so YouTube Gold Crown supporter, Gary Cunningham. Thank you, Gary. Gary says, hi, Ramin. With the power and gas problems added to the weather in China causing supply issues to the West, do you feel that the globalization idea has taken a long-term hit regards China? Yeah, I think that people are already talking about localizing their supply chains. Now, for a country like the UK, I think it's much harder to manufacture everything in the UK. For a country like the US, it's probably easier because they've got a bigger industrial base, and it's just a larger country. Whereas in the UK, if we had to be fully self-sufficient, even for food, it would be very difficult. So I think you can do so much with supply chains, but at a certain point you are dependent on external countries for providing parts for the automobile industry or ingredients for food. So to a certain extent, I think we've seen a rollback of globalization, but I don't think we'll go back to anything like, the 19th century. I think that's just unrealistic. I think a certain level of global exports and imports are just inevitable. And I don't think it would be good for the economy to completely shut down supply chains anyway, which are from outside the country. It just would be impossible nowadays. So really, I think it's just a matter of prioritizing certain inputs which are of strategic importance. We've already seen things like mobile phone networks where it's seen as a security issue if a potentially hostile foreign power is producing the parts for your very secure network. And we've also already seen in the case of things like military supplies, obviously, they're also, you might think that you didn't want some hostile power providing those things. So globalization, I don't think will go away. I think it's just going to be rejigged slightly for certain priority areas. And chips are the one everyone is aware of at the moment because, if you buy a new car, it's going to be delayed because of this chip shortage. So I think having a local supply of chips is likely to be a priority for the US. The UK might be able to do that because obviously we created ARM technologies. It's potentially something that we could start to manufacture, but there's a huge investment required for that in order to have large chip manufacturing plants which are cost effective. And so I think it's going to take certain bravery on the part of politicians in the UK in order to kind of support that development, which I think is unlikely to happen because we've already seen the government is they're already starting to think about austerity. In the latest budget, they will start to talk about paying for the pandemic. And if that's the case, they'll have to be very careful what spending they prioritise. So globalisation won't go away, it'll change. But I think it's inevitable that we'll be a very connected world forever from now onwards, I think. But in terms of investment, I mean, that's why you're asking the question, I guess. It does mean that local companies which are going to be benefiting from that supply chain shift, for example, Intel in the United States will benefit from the US buying chips which are manufactured in the US because it's probably going to shift production back home. So certain companies will benefit from that shift and that strategic shift. And certain companies are going to lose out, like Huawei obviously is no longer going to be a big chip supplier for the West. But overall, I think it would be disastrous for growth and companies if they shut down globalization as an idea altogether. Okay, back to your other questions. Second question is from A. James, who says the energy sector has outperformed in the last month. I know, because I bought Cheniere Energy, so I'm very aware of that. What are your views on how long this outperformance may continue for? Yeah, interesting question, because certainly for things like the CPI breakdown in the United States, if you look at the Bureau of Labor Statistics, they show you the breakdown. And let's quickly look at that now. Actually, we can look at it on Fred. So let me just share my screen again. So if we go to Fred, the St. Louis Fed, and we look at the CPI component, which is gasoline. Hopefully, okay, so this is the price of gasoline in US cities. And instead of looking at the actual, well, let's look at the price initially. And if we look at the price recently, you can see that it's certainly spiked. And it's gone up, but it has started to level off now. So the question is, how long is that going to continue? And if we look at all the other energy components, we'd see that as well, that they've all spiked. So it is a short-lived thing. I don't think it's going to be here for a year, for example. I think it probably will start to settle down after 3 or 4 more months. And obviously that's going to have an effect on CPI inflation as well. So if we look at the CPI print that we've just seen for the US, you can actually look at the breakdown here. If we look at what's happening with energy commodities, you can see that gasoline is still up 42% year on year. But when we look at that actual price increase, you can see that it's starting to level off. So if we look at the monthly figures, you can see that in March it was up 9.1%, but then it started to flatten. And August and September it was only up 2.8%, 1.2%. So that's already starting to top. And if we look at used cars and trucks, you know, that's already down to 24, and that was at 40 as well. So I think a lot of these supply chain issues will start to disappear. For the liquefied natural gas, I think it's slightly different, because usually China's purchases of liquefied natural gas are kind of backloaded towards the last few months of the year, because it has to keep China warm. And because it's trying to reduce emissions, it'll probably switch from coal to gas. So it's going to be a big buyer of liquefied natural gas, and that's going to squeeze smaller markets, particularly the UK. Although in the UK, I've also seen today that the pipeline from Russia has eased some of those supply issues somewhat. We get a lot of our we get a lot of our gas supplies from Norway in the UK. So obviously that won't be disrupted, because those are undersea pipes, I believe. So I think it will be short-lived, but potentially it'll last until after this Christmas period and into the spring. But then I think it probably will abate. But, you know, as I said, I bought Cheniere Energy. So, I mean, I can show you the share price. It's up about 5 or 6% last time I checked, relative to where I bought it, because that's a big supplier of liquefied natural gas from the United States. Another big supplier is Gazprom from Russia, but I didn't go for that one. I know that one of the PensionCrafters did, actually, because he mentioned it on Slack. But anyway, yeah, so that's, I think, a short term, but longer than used cars and trucks. Okay, so back to your questions. What are the key risks or considerations when investing in a preferred shares fund or ETF as opposed to a normal shares fund or ETF? Thank you. Okay, so let's have a look at one of those preferred ETFs, because that's kind of interesting. I think there's one from iShares, just in case people aren't aware of what a preferred share ETF is. Okay, have I got one? iShares preferred. I've got a prospectus. Let me just try Googling it, and I'll share my screen again so you can see what I'm doing. iShares preferred shares ETF. Here we go. So PFF is the one I'm familiar with. So let's just look at the quick summary of the fund. So exposure to US preferred stocks, which have the characteristics of bonds, pay a fixed dividend, and stocks represent ownership of a company. Access to the domestic preferred stock market in a single fund. And the whole purpose of these things is to generate a high income. Plus you can potentially get some capital gains as well. So if we look at the dividend yield on this thing, it should be high relative to, say, dividends on stocks or compared to treasuries. So let's have a look. So it's got 499 holdings in it, and the yield on it is pretty high. So the SEC yield is 4.2%. The trailing yield, which is how much is paid out over the last 12 months divided by the price today, that's about 4.5%. So that is pretty juicy in terms of yield. If we look at the sector composition, I suspect it's going to have a lot of financials in it. Yeah, so financials make up 60% of the fund. That's because mostly it's banks which issue preferred stock, because it's a way of shoring up their capital structure. And It does form, I believe it forms tier 1 equity, which makes them look good because it's loss absorbing capital. Now with preferreds, if the income of the company starts to struggle, one of the risks is that they'll stop paying out a very high dividend. So if it does look like we're about to enter a situation where financials will struggle to generate a lot of income, then they may choose to defer the income on their preferred bonds. So I suspect if we look at the risks of this thing, it's going to tell us that that's one of the risks. Usually they have a kind of list of the risks with these fact sheets. Maybe it's on the prospectus, but that is certainly one of the risks. Product brief, maybe. Key takeaways, risks. Yeah, I can't see anything about the risks here, but usually they kind of have a fairly long list of what can go wrong. But again, here you can see that the breakdown of the sector composition, a lot of financials, not just financials, but dominated by financials. And but what they say is that these preferred securities have low correlations to traditional core bonds and can potentially provide attractive diversification within a portfolio. They do tend to be fairly illiquid in terms of the pricing. So if you look at the price of a preferred over time, what you'll generally see is that it kind of it's not very. Sometimes it goes for a while without trading much. You know, you won't see very big price fluctuations. They tend to be fairly illiquid, but you buy them because of that lack of correlation to bonds, but the high income. And the risk is that the financial sector runs into trouble and you don't get paid your coupon. Unfortunately, it's the drawback with them is that oh, here we go, repayment layer. This is a nice graphic that explains what's going on. So in the capital structure, if you're the holder of senior debt, in other words, if you buy one of the bonds issued by a bank, then you'll be paid off first in the event of a liquidation of the company. And you'll probably make back 40% of your capital if the company goes bankrupt. Subordinated debt will be second in line. Then you get to the hybrid debt. Then you get to the preferred shares. And then you get to the common shares. So the chance is by the time you get to preferred shares, there'll be nothing left. So if the company does go bankrupt, which is unlikely for a financial, but it does happen, then you'll lose 100% of your investment. So that's a risk. And the other risk is that they defer the payment of coupons if they run into revenue problems. Again, that's unlikely in the current environment when we've seen fairly brisk revenue growth in that sector. So certainly at the moment it's not an issue, but just be aware that it's very cyclical, that sector. So when we're bouncing back from the pandemic, it does well in terms of capital gain. But if we're entering a recession, particularly a deep one, I'm not sure I'd want to be exposed to preferred shares in that kind of environment. So I hope that helps you gauge the risks for a preferred fund. But it is a risky asset as well. So if equity markets fall, then this thing will fall too. So let's have a look at, is it PFD? I think the ticker was. So let me just, actually I'll use SharePad. So PFD, preferred, it'll be a NASDAQ one, I guess. Preferred. And we'll look under ETFs. High quality preferred ETF, so EPRF, PFFD. Okay, well let's use, can't see the iShares one here. iShares, here we go, PFF. So if we go back to March, what you can see is that it did sell off quite a bit. So it is a risky asset. Just be aware that when equity markets sell off, so will this thing. and it sold off by quite a bit. So it was down by about 34%. So yeah, it's a risky asset, and you should just be aware of that. It's not like a bond, although it pays out a high income like a bond. It's very much a risky asset, and if equity sells off, this thing will sell off a lot. Right, back to me, and back to your questions. So the next question is from, if a company does not need to raise capital, in which other ways does the price of its shares affect the company, either positive or negatively? Well, for starters, I think the management of the company often gets incentivized by having stock options. So if the company's share price does well, then they're going to get richer. That's probably not much of a comfort for you. So that would affect the company, I suppose, because this is the causation working the other way, though, because if they are incentivized with stock options, they'll want to push up the stock price. That's the whole purpose of giving them stock options in the first place. But in terms of the actual company, I think the share price is a signaling thing. So if you see the share price rising, you could argue that people will have more confidence in the company. So for example, if you look at Tesla, you can see the share price going crazy. It creates this kind of halo effect where people think, oh, the share price is great, I own the stock, I'll buy the car, maybe that improves sales. And certainly from the point of view of investors, a rising share price means that if they ever do issue more stock, they can do it more cheaply. They have to give away less of their company to get a certain fixed amount of capital. So for future fundraisers via the equity market, it could potentially help them. But you're right, in terms of directly helping the company, it doesn't, not directly. All of these are kind of indirect effects until it decides to raise capital again. So when you buy ESG stocks, for example, are you directly helping the company? Not really. But if a company has very good stock price performance, then, as I say, I think it creates this kind of halo effect. And so eventually that's going to help the company, but also make more people aware of it by buying the stock. I think that's likely. Okay, next question is from Musa Absi. I think I've seen your comments before, Musa. Thank you for joining us. What are the cons of investing in ETFs as in liquidation issue and all the horrible things I read about it? It can't be all roses. Yeah, I mean, if there is a liquidation of an ETF, remember that it's not a catastrophe. It happens all the time. And because there's such a rapid issuance of new ETFs, then the death of ETFs is also happening very frequently now. So, there are hundreds of ETFs that get closed every year simply because there's no interest in them, or there's not enough interest to make it worthwhile for the company to run the ETF. So there tends to be this kind of scattergun approach where they just overproduce these ETFs, and, if something sticks, great. If it doesn't, they just close the fund down. From your point of view, there's very little risk if an ETF is closed. What it actually means is you just get your money back. The value of the ETF is based on the value of the assets held by the ETF. There's no counterparty risk with the fund manager, the ETF fund manager. They're very much just a kind of custodian of the contents inside the fund, particularly if it's a passive fund. So I really wouldn't worry too much about the risk if an ETF is closed down. But are there other problems with ETFs? Yeah, I mean, I did a YouTube live with Robin Wigglesworth, who has written the brilliant book Trillions, which is all about ETFs and index funds, more generally into index funds. And he devotes the last 4 chapters to the risks of passive investing. So I think, there are risks with ETFs and with passive investing. One of them is the dominance of index companies. Very few people appreciate, I think, how powerful companies like S&P Dow Jones is, or MSCI, or FTSE Russell, who create these indices like the S&P 500, which are tracked by trillions of dollars. Literally deciding that one country or one stock is put into the index forces huge amounts of money to flow into that stock or that country. And so it becomes political in some cases. For example, he gives a story about Peru, which was threatened with being taken out of the EM index and being put into the frontier index, which is like the next league down below emerging markets. And the financial minister had to actually fly to New York to complain to MSCI and say, look, please don't do this. Liquidity of our stock market is fine. Don't relegate us to a frontier market, please. So it does have political implications, and it also has implications for individual companies. And there was an article in the FT also about some companies buy an S&P credit rating because they think it will actually put them in S&P's good books for inclusion in many of these indexes. So it'll help their share price as well. So just bear that in mind, because that is one of the negative, I'd say it's a negative factor for ETFs. But look, I think the vast majority of benefits that we get of cheaper investing, wider selection in terms of things that we can buy, like preferred shares, only institutional investors could have bought that, like hedge funds and pension funds could have bought those things 20 years ago. But now we've got ETFs, which literally let us get very high income from banks because we can buy this part of the capital structure, which was unthinkable 20 years ago. You'd have needed to be very wealthy or a hedge fund in order to do that. So I think that's why it's really revolutionized exposure to markets, the cost of investing. That's come down for everyone, and it's literally saved people hundreds of millions, if not billions of dollars in terms of fees. So I think that's the kind of, it's vastly positive with some negatives, like electric cars, right? So electric cars have some negatives, but on the whole, they're probably the way forward. So I think I wouldn't throw out the baby with the bathwater. But you're right, it's not all positive. Anyway, Robin's book is brilliant. It's the last 4 chapters. He talks about the negatives, and I think he covers that very well. Question?
Yeah, they're fine.
Okay, so we have some questions from our supporters. And Zisham, thank you for supporting us. I appreciate it. So Zisham and Gary, thank you. For particular tickers on Yahoo Finance, say Tesla, I've seen options pricing with a strike price that changes to call and put. What do they represent? I've seen options pricing with a strike price and changes to call and put. I can take a look, if you like, at the Tesla call options on Yahoo. And if you have a kind of follow-up question, then please do ask it, and Laura will kind of pass it on to me, because I'm not sure I understand what you mean. I mean, certainly the call prices and the put prices will be very different, but you're talking about changes. I'm not sure what you mean by the changes. Maybe you're talking about the changes in the values. Let me just share my screen so everyone can see. There we go. So this is the page which describes the Tesla calls and puts. So these are calls. So these give you the option to buy Tesla stock on October the 29th at a fixed price. So obviously you'd like to buy at a low price. So the call options which are a low price will have a high price. So these are the calls, and you can see that the 100 strike call is worth 963, And as we increase the strike price, it becomes less attractive to buy at a higher price. And you'll start to see that the option premium is falling until it gets deeply out of the money when the option premium falls to a very low level. So the changes you can see here, I guess, the change here column, I think this is what you're asking about, is how much I guess that's changed over some period of time. So probably a day. So you can see that this premium has gone up by 60%. If we get closer to the money, they'll be more liquid, so we'll get more reasonable changes. So all of these options, which are probably close to being out the money, all of these have gone up by about a third. So that's because the share price has moved up, and that's what's driven the price of these options higher. And if we look at the puts, then what we'll see is that the value of the puts has fallen because that's an option to sell, and that's become less valuable if you want to sell at a fixed price, because the share price has moved up. So yeah, I mean, that's what these changes are telling you, how the price has changed over some period of time. So let's have a look. Let's have a look at the point at which the call and put option premium is roughly the same. I wonder if we can do that. I don't think so. But anyway, yeah, I think that's what you were referring to. Those changes are just how the option premium has changed. Right, so back to your questions.
That's Gary.
Oh, question from Gary, who says, am I still on sharing screen? No, I'm not. Good. Gary says, could the UK government try to bump inflation to reduce debt, which would cause issues with the Bank of England? Okay, there are certain kind of conspiracy theories about what the Bank of England would and wouldn't do. I think the idea that you could inflate away your debt is kind of like a false belief amongst many people. The idea being that if inflation goes to say 10%, then any outstanding debt which the government has gets inflated away, and that reduces their debt load. But the problem is that if inflation goes to 10%, usually that comes with low growth, because that will hugely damage the UK economy, having super high inflation. And growth being slower means that the government's income also reduces, and that could actually act in the opposite direction by increasing the debt to GDP ratio. Because if the GDP is shrinking, then the debt will decrease a bit due to inflation, but the debt to GDP ratio may get bigger because you're dividing by a smaller number. So remember, debt to GDP is what matters, because that tells you how sustainable debt is. If a country has $1 trillion in debt, that's not a problem if their economy is a $20 trillion economy. If they're a $100 million economy, that's a problem, right? So it's a debt to GDP ratio which determines the sustainability. But could the UK government try to bump inflation to reduce debt? It would be catastrophic if they tried to do that, because the level of inflation you'd need to inflate away the debt would be huge, much more than 5% to do it significantly. So I just don't think the Bank of England would ever even consider doing that. The way to get out of debt to GDP being high is to grow your way out of it. That's what the government wants. That's what the Bank of England would be telling them to do. They would never advise them to try and get inflation to high levels. No sane government would try to do that. So I just don't think that would happen. So the Bank of England would try and stop inflation being high. I mean, the government can do certain things to increase inflation. Brexit, for example, was inflationary by reducing the labour pool. And that means that there's more competition amongst workers for the same jobs. That means that the people who've got jobs in the UK, have more kind of job security because there are less people able to do that job. And that means they can probably demand higher wages. And by design, we've tried to increase wages of certain groups of society in the UK. And that will be inflationary. It will feed through to higher prices for the rest of us and for those people. So I think the government has had inflationary policies, but I don't think it was to inflate away the debt. I think that it was Brexit was one of them, but I don't think the government would deliberately try to engineer debt, try to engineer inflation above 10%. That would be crazy. So I don't really buy that. The Bank of England will also be aware that they can't fix supply chain issues by increasing interest rates. That just doesn't work. The kind of inflation which is stopped by higher interest rates would be things like demand pull inflation, when you've got very large growth in the economy, which leads to higher wages, which leads companies to raise their prices, and then you get the wage price spiral, which embeds high inflation and creates this feedback loop for ever higher inflation. So that kind of cycle can be broken by higher interest rates. But supply chain issues won't be affected. High oil price won't be affected by higher interest rates. That's an exogenous factor, they call it. So I think the Bank of England has to look through these things like the oil price spike and the supply chain issues for core inflation drivers. And that's what their army of economists will be doing right now, you can bet. So, I don't believe these kind of conspiracy theories, no. So back to your questions, and we've got one from there's one here about someone says I've highest trust levels for you on YouTube. Thank you, Andrew. Andrew Sinner says that. It's very kind of you. There's a question from Zishan Ramin who says, hi Ramin, your thoughts on the EV sector about recent increase. So you think valuations are justified? Probably not. I think there's a lot of hype at the moment, and this is why I had so many things on my market crash shopping list. That's the video I made last week, because I think a lot of things at the moment are still overpriced, and I think that EV is one of them. Obviously there has to be optimism for the sector, but I think there's too much optimism priced in, and at a certain point they just have to create huge earnings growth to justify the valuation, and they'll fail to do that because valuation for some of these which have very poor profitability, or even they're loss making, and yet their price is still going through the roof. And Tesla's one example of that. It's just overpriced. It's ridiculous that it's worth more than the next 10 largest auto manufacturers. I mean, that's crazy. So I think at the moment, I think the EV sector is overpriced. But again, if there was a correction in equity markets, a severe one, that's certainly a sector I'd consider investing in. My list is getting very long, I've got to say, of things which I'd consider. But if you watch that video, you'll see the 5 items which are on my list, at the top of my list, for a crash. Apothos6, who says, has growth outperformed value because of the easy money government policies? Will value win out after interest rates rise? That's the conventional thinking. The idea being that growth companies depend more heavily on interest rates being low. Perhaps that's because they're borrowing in order to expand, although I'm not sure that's true. But the logic is that they depend more on interest rates. So if interest rates increase, you'll see tech sell off. Usually that's what happens. The Nasdaq gets hammered every time we've seen the US long-term yields spike a lot. That's certainly a relationship which we see at the moment. And if that stops, if interest rates do start to rise, then perhaps some of these value stocks will start to recover. And that's certainly something we did start to see at the beginning of this year. I think if I look at here we go. So if we look on Coifin, let me just share my screen again. So if we look at Coifin, it actually has a nice market dashboard which looks at factors. And if we compare growth and value, so that's what we've got here. So IWF is growth, and that's the red line. And then the blue line is value. It did look like there was kind of like a reversal at the beginning of 2019. If we look year to date, at the beginning of this year again, you can see that value looked like it was just about to really take off, but then no. We got until June and value started to tank and growth started to recover. And I think that's partly because, we really haven't seen yields increase that much. So another thing that we can look at here is US. So this is looking at UK rates. If we switch to the US, so I'll switch off the UK and I'll switch to the US. Yeah, so this is a US 10, 20 and 30-year yield. We have seen yields come off their lows, which we reached in 2020, but they still haven't gone back up to where they were, say, in 2019. They're still well below those levels. They're also below where they were before the pandemic hit, which was around January 2020. So you can see the 30-year was at around, 2.3%, but the 30-year now is only 2.1, around 2.1. So it's not quite back to where it was before the pandemic, and it's nowhere near where it was in 2018. So we haven't really seen yields start to take off. I think once we start to get the Fed talking more about tapering, that may happen. And once we start to see wages, once we start to see the unemployment rate in the US go back to levels that are close to, where it was before the pandemic, then we'll start to see yields increase a lot more. But at the moment, I still think there's the risk of a policy accident from the Fed. In other words, they raise rates too soon, and then everyone will be panicking and equity markets will sell off. Or there could be a growth disappointment like we saw today. US GDP was only up about 4%, I think, year on year. And the quarterly growth was even worse, about 2%, something like that. After we've just come off a 12% year-on-year growth in the previous quarter, that seems pretty weak. So COVID is still having an effect on US consumption, and yields reflect that. And I think people are coming around to the idea that, the huge bounce back and resurgence that we were expecting after the pandemic is actually just turning into a bit of a fizzle, and yields are kind of expressing that view by not rising as much as you might expect if they were pricing in a lot of growth. Because remember, yields are driven by growth expectations. Okay, so back to the questions.
Arsenio.
Oh, Arsenio, nice to hear from you. Arsenio, who says, Arsenio Cornelio Panesi, who has the coolest name, says, "Hi Ramin, does a correction always imply a drastic drawdown? Or it might be that equity prices just side trade for a while till PE ratios mean revert." So you also ask what Koifin is. So Koifin is kind of like Bloomberg for refugees from the investment banking world. So it's kind of very good for prices it's very good for yield data, very good for market news, very good for screens which display things like factors, currencies, economic indicators, or displaying yield curves. So I think it's a pretty good data source. The version I've got is a free version, but if you pay something, I can't remember what the fees are, but you can get a version which has the ability to download data. For my primary data usage, I still use SharePad, but for non-UK data and for interest rate data and for factors, I generally use Koifin, which is pretty good. But your question is about a drastic drawdown. So correction, I mean, the definition of a correction is that it's a 20% fall. A correction is a 10% fall, A bear market is 20%, I believe. But these definitions are just kind of made up, But I think what's likely to, or certainly what's been driving valuations recently, has been unbelievably good earnings growth. So if we look at the price to earnings multiple for the US right now, let me just switch to that so you can see it. Then what you can see here is the price to earnings, the forward price to earnings for the S&P 500. And you can see it spiked after the pandemic as huge numbers of people bought into equity. But then it peaked in September. And then gradually this year, it's been falling downwards quite sharply. And that's because of the huge earnings growth that we've been seeing. So if you look at the quarterly earnings growth for this quarter, or the last quarter actually, compared to 4 quarters previously, there was an 80% increase in earnings. So it went up to 52.80 from 28.25. So it's an 80% increase relative to that very poor earnings, which was from Q2 2020, when we had the pandemic really start to affect earnings. So that's the kind of valuation fall which I love to see. It's not because equity markets have been falling, it's because earnings have been rising to support valuations. But it's still above the 5-year average and above the 10-year average. So it's still expensive, it's just less expensive. So for the next 2 quarters, we're probably going to see roughly 20% earnings growth. But then we'll get back to boring earnings growth, which is about 5%, according to FactSet and according to broker forecasts. So for the next 2 quarters, everything will be fine, so the brokers say. But then we'll start to get a little bit more shaky. So that's the point at which I'd start to get more concerned about what could happen to US equity, because the support of very strong earnings growth is going away. All the euphoria about the post-pandemic recovery will be fading. We'll still be left with these tail-end supply chain issues, probably, maybe lingering inflation, combined with a Fed that's raising interest rates. So all of that kind of paints a kind of more depressing backdrop, plus COVID maybe dragging on or mutating into new forms. So I think there's a lot of scope for accidents, which could kind of spoil the party. But I really am not that pessimistic about equity at the moment. I'm still building up my 80% allocation month by month, drip feeding, and I still remain fairly optimistic about that. Let's see if there are any other questions. Nope, that's it. Right, so we've got 8 minutes. Don't forget to like and subscribe, and don't forget, if you want a one-to-one with me like this, but just you and I, you can book a power hour with me, and there'll be a link to do that in the description of the video. Laura's nodding. That's good. And you can also join us on Patreon, and that way you can vote for your own video content, which only you will have access to. So I make these one of these a week, but only for members, and that's an explainer for our Patreon supporters, and you get to talk to us on Slack. So Patreon is kind of like family, right? So it's very friendly. We kind of support each other with the investment ideas, and collectively they have more wisdom than I do now about topics, and generally they help each other very, very much. Right, so back to your questions, and we have 7 minutes. Next question is from Stefano, who says, "Hi Ramin, ETF is quoted in different stock exchanges, in different currencies, and can save custody fee in local market. Why in some exchanges there's no transactions? What happens to my orders?" Yeah, I mean, sometimes you'll see that an ETF is listed on multiple exchanges. You often see that with iShares ETFs, for example. Some of those exchanges, there won't be much trading of the ETF, simply because there aren't market makers for it. A market maker has to agree to make a market for a stock, and it may be that no market makers are willing to do that. So if it's a very obscure stock, which probably doesn't have much volume, So say, for example, that preferred share that we saw before, that preferred share ETF in the US, would that trade in Germany? Probably not. You know, it might be listed, but the trading may not happen because there aren't market makers for it. So if you place an order, you've got to place it on a liquid exchange. So I know that my broker, one of my brokers, can place exchange trades in the US. It can trade on the US exchanges or on the UK exchanges. So really, you've just got to look where the liquidity is. And, you know, I mean, you'll see from the stock market listings, if you look on Yahoo Finance, you'll see what the volume is for every exchange for a given ETF. So you'll be able to see how liquid it is based on the number of trades. So all I'd say is you're probably better off placing it where there's most liquidity, as long as you're willing to take the currency hit if it's not your domestic market. Usually it'll be more expensive to trade on a foreign exchange because of that currency conversion, I'm guessing. Also, you're taking the currency risk. Your orders are going to be put wherever the liquidity is, but you'll have control over the currency and the exchange probably. Right. Seb Fox says, "Hi Ramin, I'm interested in investing in China and recently bought a position in the KWeb ETF. Me too, unfortunately, that's down 50%. However, I'm a bit concerned about the delisting risk for variable interest entities, ADRs, on the NYSE, the New York Stock Exchange." Me too. I'm also concerned about that. Not because of the risk in the US. I think I'm more worried about the risk in China, that the Chinese government says that variable interest entities are no longer allowed. And if that's the case, the value of the KWeb ETF would be at peril, right? So that's my worry. It's already down 50%, but I think more ETF companies are going to start thinking seriously about whether they want to get exposure via variable interest entities. I think it's a risk. I think you're right to be worried about that. And I think that's part of the reason why it sold off so much. It's not just because of the Alibaba risk. It's also because of the structure in which it's embedded. So that is a concern, and I'm worried about it too. So you'd be interested in similar ETFs that get exposure directly via listings in China, Hong Kong. Can you point me in the right direction to find such China ETFs? Yeah. So if you go to iShares, for example, iShares has MSCI trackers which get direct exposure. So if we look at just ETF, for example, or actually let's look at ETFDB in the US because that's probably got more choices. And again, I'll share my screen just quickly so you can see this. So China ETF list. Here we go. So these are China ETFs, and KWeb's top of the list because it's the biggest one. I think these are sorted by total assets. The second one is this MSCI China ETF, and I believe that one doesn't use VIEs. So if we look up MCHI, if we look in the term sheet, in the fact sheet from iShares, usually they're very well written. And I think one of the risks they usually list is that they can't get enough liquidity in order to trade the stock, because there are limits on how much individual traders or individual asset managers can trade, and it may be that one is limited. Let's have a look at the fact sheet, because I remember reading this when I did a video about this, and one of the risks that they listed was that they wouldn't be able to have sufficient liquidity. Here we go. International investing involves risks related to foreign currency, limited liquidity, particularly for this one. So there's a risk that you can't trade enough in order to match the index. So at worst, this would mean that if there's a very big move in the Chinese market, that you wouldn't track very accurately and that the tracking error would blow up. But that's probably the worst that would happen. And when market conditions resume, then it would snap back to the correct value, probably. But you could have an unpleasant week when you don't get that good tracking. So just be aware that that is a risk, even with these stocks which buy directly on the Shanghai exchange or the Shenzhen exchange, because there is a limited liquidity availability for these foreign entities like BlackRock, which would be managing the fund. So there's still a risk, even though it's not via a variable interest entity like KWeb. And those are risks you should be aware of. Okay, and how are we doing for time? It's 8 o'clock, so we'll end there. And I think the burger's about to arrive. I'm hoping. Teddy hasn't barked yet. Wake up, Ted. He's doing a very poor job as a guard dog. There you go, mate. So he's going to get some of the burger as well. So thank you all for joining us. It was great to have you on the call. Remember, you can always like us. It helps us if you just click on the like button, subscribe to our videos, join our membership on Patreon, or support us here on YouTube, because then when we have these sessions, you'll get pushed to the front of the queue in order to have your question answered. And it's quite inexpensive. The YouTube supporters subscription level is very low. So, and we did that deliberately, didn't we, Laura, so that more people could do it and just feel that they were supporting us in producing good content, which helps you. So thank you all for joining us, and we'll see you in 2 weeks' time. And should I mention the Far East? No. Okay. Anyway, so that's fine, and we'll see you in 2 weeks' time. Have a great 2 weeks, everyone, and see you then.